3 times a week, the options market provides traders who have just a little bit of knowledge a unique opportunity to use one-day option strategies with sometimes incredible results. I'm Seth Freudberg, the head trader of SMB Capital's options trading desk here in Manhattan. And professional options traders use one-day trades all the time to profit without having any exposure to overnight gaps, which can wreck trades if the move is big enough. So if you're interested in learning a very easy one-day options trade involving a very recent example to drive the point home, then stick around because I think you're going to find this pretty intriguing. Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. The RSI, the Relative Strength Index, is one of the most popular momentum indicators used by day and swing traders, and it's displayed in the form of what is known as an oscillator, which fluctuates between two conditions. Generally speaking, when the RSI reading is above 70, that's known as overbought and indicates that the stock is likely ready to sell off, as the term implies. And a reading of under 30 indicates what are called oversold conditions and are indicative of a likely rally. Now, before we get into exactly how we're going to use the RSI indicator to make this one-day options trade, I'd like to let you know that if you want to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video, or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. In order to teach you this strategy, which uses S&P 500 index options, we're going to do a really quick review of how index options themselves work. Just hang in there if you already know this stuff. This is going to be quick, and then we'll jump right back into the strategy. The best way to understand index options is to think of them as bets. What are known as a call option pays off if an index closes above what's known as the strike price of the option on the day that the option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call's strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So, for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 40.75 call would expire worthless, as the index did close above 40.75, so the call seller just pockets the premium. And the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put's strike price of 40.75. But the 4,000 puts would expire worthless because the market didn't close below that 4,000 strike price. Okay, so keeping that in mind, let's get back to last Friday when the S&P 500 index opened at 4478.30, and as you can see from the indicator, the RSI indicator immediately went into that oversold condition below a reading of 30. And so the way that this strategy works, we would start the day by opening up a bullish trade by moving down to about 10 points below where the market opened. And so the nearest option strike price to that is the 47.70 strike. And so we'd go ahead and sell 10 of those 47.70 puts. And this part's important. Those options have to be executed on the options expiring that day, that very day. And since SPX index options expire, generally speaking, on Mondays, Wednesdays, and Fridays of each week, you can do this trade 3 times a week once you get the hang of it. Okay, and so not only are we selling 10 of the 44.70 puts expiring that day, but we're also buying 10 of those 44.60 puts. And this combination of selling a put option below the market and buying another put option further from the market is what is known as an out-of-the-money put credit spread to options traders. And it's actually a bullish trade, as you'll understand in a minute. Let's first understand what's happened from a cash flow standpoint before we go any further. And so let's start with those 10 44.70 puts that we sold. And as we mentioned, we received a price of $18.05 for those. But remember, for each point that the market closes below 47.70, those options pay off at $100 per point. So we multiply that price by $100, and we sold 10 of them, remember. So that comes to a total of cash received for selling those 10 options of $18,050. But then we have to turn around and pay $14,750 for 10 of those protective 47.60 puts. And so when you net it down, we actually receive in $3,300 for entering this initial part of the trade, which your broker will require $6,700 in capital to execute, which is also the worst case scenario loss on the trade. Now, remember, this is a one-day trade. And so the way that this strategy works, we remain in the bearish trade until the RSI indicator flashes an overbought condition, meaning that the indicator has now moved from its bullish stance to now a bearish stance, which will typically happen after the index rallies for a while during the day. And the indicator is essentially saying that this rally is overdone, as you can see from this slide. And so at this point, we'll close the initial bullish put credit spread position and replace it with a bearish call credit spread, but this time above the market price to give ourselves some room with the short call at 45.10 and the long calls 10 points higher than that up at 45.20. Now, you may be wondering, why are we calling a put credit spread a bullish trade and a call credit spread a bearish trade? To some people, that's confusing because they associate puts with sell-offs and calls with rallies. But remember, we're short a more expensive put option below the market price of the index when we are bullish, and long a less expensive put option farther from the market price. And so they both shrink when the market rallies, but the more expensive short put shrinks faster than the less expensive long put. And so let's see that in action here on this slide, because remember, originally we received $3,300 initially when we entered the trade, and to close that side, we have to first buy back the 44.70 puts for $3.80, resulting in a cost of $3,800, and simultaneously selling the 44.60 puts for $235, resulting in income of $23.50 for a net total profit from closing the put spread of $1,850. And that's because as the market rallied, the short puts lost value at a faster rate than the long puts because they were closer to the market price in the first place. And so now you can see why an out-of-the-money put credit spread is a bullish trade. But we're not done, because we've now added the call credit spread when the RSI turned bearish, which also brings in cash. And so as you can see, we received $10,550 for the 45.10 calls, but we paid out $66.50 for the protective 45.20 calls, resulting in a total positive cash flow from the call spread of $3,900, which, if you add it back to the profit we received from closing the put credit spread, results at this point in the trade with a total positive cash flow between the profits on the put spread and the new cash flow from the call credit spread of $57.50. Okay, so now let's move to the end of the day. And as you can see from the price chart, the RSI did not cross back into bullish territory until the final minutes of the market. And at that point, it's too late to enter a new bullish trade because the market's just minutes from closing and those options are about to expire. So that's too late in the day for a one-day options trade. And so the market simply closes at 4,560 cents and the options trade expires. So where does that leave us with our options trading campaign using RSI? Well, let's think about it. You see, if you start by acknowledging that you received $18.50 profit from the original put spread, and then you focus on the fact that both the 45.10 and the 45.20 options expire worthless because they expired above the market price of 45.60, and you then add back in that cash that you got from selling that bearish call credit spread, you have a final profit of 57.50, which constitutes a return of more than 85% on the original capital that your broker would have required you on this trade. And so what I'd like you to take away from today's video is not that using the RSI indicator in this way will always result in trade profits, because with any trading systems, there are cases where it won't work. But what I do want you to focus on is the fact that using credit spreads to express bullish or bearish biases during the day can be extremely profitable if your indicator is reasonably accurate and you manage the trade effectively, like today's example illustrates. Professional traders understand how to use these and other option strategies to leverage technical indicators that they're comfortable with. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.